Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by United Wholesale Mortgage.
Is TRID slowing you down? Not if you're closing with UWM. While other lenders are struggling, we're closing most TRID loans in 15 days or less. Thanks to easy-to-use tools like UClose and Ease, and direct communication from submission to close. Get United at UWM.com.
Welcome to Master of the Markets. I'm Barry Habib at MBS Highway, and this is created exclusively for Mortgage News Network. It's brought to you by United Wholesale Mortgage, a great company who's got some great tools for you to use to help you, like EaseDocs. You know what? On your application package, why don't you generate one that your customer can just do one-click sign, and you are done. Beat your competition, save time. You know what? We did get the Fed rate hike last week, and we thought that it would help mortgage rates improve over the longer term, and we thought that mortgage rates would like it, and sure enough, that's what happened. Yes, the Federal Reserve hiked rates by 1/4%, finally getting off that 0 to 1/4, and now it's 1/4% higher, so we are in the range of 1/4 to 0.5%, so let's call it a median of 0.375% is where the Fed funds rate is. That actually helped mortgage rates over the past few days. We've seen them rally. Stocks, not so much. Initially, they did well, but they have faltered since. So what about the Fed? What does this mean from here? Well, there's a lot of talk as to what the Fed might do next year. And in 2016, the first thing we need to do, much like we did in 2015, while everybody, remember, was saying that the Fed was definitely going to hike in June of 2015, this is the beginning of this year, the beginning of 2015, we said, oh, Fed guaranteed hike in June of 2015. We said no. We said, maybe no hike to possibly one at the end of the year. And you know what? That's exactly what happened. So what helped us in that determination is we look a little deeper and we looked at the makeup of the Fed, but not just the Fed, the voting members, the ones that count. So let's take a look together at that. See, when we started 2015, we realized that there were 4 centrists on that Fed voting member board. So the 4 voting members of the Feds that were centrists are Fisher, Powell, Williams, and Lockhart. And these 4 were kind of middle-of-the-road individuals, not really in a rush to hike rates, not really super dovish, meaning they don't want to be super accommodative. But look at the accommodative ones, and certainly very influential is Janet Yellen, which is obviously the Fed chair. And then you have 4 others that are very dovish, especially Charlie Evans, super doves, very accommodative, want nothing to do with rate hikes typically. And then you had one hawk, Jeffrey Lacker, who obviously has dissented in the past and wanted to see a Fed rate hike sooner. But it did take some time to bring these people around. At the beginning of the year, when we saw the makeup of the Fed, we said, it's not going to be one where it's going to be as quick to hike rates, especially a June rate hike did not look like in the cards for 2015. Well, let's move forward and see what the changes are for 2016 and what that could mean for the Fed. Well, first off, we lose that Chuck Evans, who was the super dove. We also lose a couple of centrists, and we lose the big hawk. Now, who do we replace them with? Well, we were going to replace them with Eric Rosengren from Boston, and Eric is very dovish. But we also see 3 hawks come into play here. And those 3 hawks are Bullard, Meester, and Esther George. And Esther George, a pretty strong hawk. So the makeup of the Fed is different now. We do have a much more hawkish looking Fed in the year ahead. So I think that we could see some rate hikes. How many? Well, let's take a look and see what the estimates are. I'm showing you here the dots. And the dots, you may have heard of this. What this means is each Fed member, we don't know who they are, they keep some anonymity, but each Fed member puts a dot where they think interest rates will be in each year, in 2016, 2017, 2018. So forget the longer term because the Fed is absolutely miserable at forecasting. And they change these around. So in September, here's what they had said, and here's where they are now in green. So September is the purplish color. Green represents where they are now in the December meeting. This is just a few days ago, last week at the December meeting. So if you take a look for next year in 2016, the majority of them think that we will be at 1 3/8, which would represent 1% higher than here, or if you take a look at each rate hike being a quarter, 4 rate hikes next year. Now, there's 8 Fed meetings, so this could be about one every other Fed meeting. That isn't really in tune with what the market is predicting. If you take a look at the futures contracts in the market, they're only looking at 2 rate hikes. Now, if you take a look at the differences in the past, the market has been more accurate than the Fed at predicting this. So what do we think? Well, I'll tell you what, I think that we may get 1 Fed rate hike next year. We may not get any. It depends on what happens in the economy. We're seeing some slowdown in the manufacturing sector, not a lot of inflationary pressure out there. So unless inflation picks up, I mean, look at oil prices right now, below $35 a barrel, certainly helping to keep inflation low. Foreign central banks are in a position where they're adding more QE. That keeps our inflation low as they try to import inflation. They export deflation to us. So all of these things, in my opinion, help to keep inflation low, which is really what drives interest rates. So I'm not so sure we're going to see many Fed rate hikes, or as many as the Fed's predicting for. Could we get 1 or 2? Yeah, certainly, but it really depends on the health of the economy. So what does this mean for interest rates? The low inflation environment going forward means that interest rates are going to probably be really good in the year ahead. Now, there is one story here you need to keep an eye on. There's a hedge fund called Third Avenue. They deal in high yield, and this hedge fund closed its doors. Why is this so important for us to look at? You know, the proverbial canary in the coal mine. Coal miners used to bring a canary down with them, and if the air quality got too poor and the canary died, they knew it was time to get out, right? So could this be a canary in the coal mine? It possibly could. Remember, with subprime years ago, people thought, it's just kind of contained to subprime. Well, that was wrong. Now, I'm not saying this to sound alarm bells, but I want you to think a bigger picture here. High yield products are something that a lot of people look for because you can't get a lot of yield out there. So high yield was perceived to be a higher yield but pretty safe. Why? Because a bunch of the returns that they were getting were from energy sector, oil and gas companies. Now, they were making lots of money, but they could afford to pay higher dividends. So the yields were higher, and they were still pretty darn safe and performed well. Well, what's happened to the energy sector? Energy prices very low, companies losing money. Those that issued bonds or got into debt that were picked up by these high yield funds may not be able to make timely payments or payments at all. And that's why some of these high yield instruments are not performing well. Now, as people start to want to redeem these and say, hey, what we want to do is get out, maybe their financial advisor said, you know what, probably a good time to get out. So a lot of people rush to get their money, and these funds now have to liquidate assets. You can't really liquidate the assets that are not performing. You know, the old saying, you can't sell what you want, you sell what you can. But what can they sell? Good assets. And by selling good assets, that might include things like mortgage-backed securities. So this is a wild card here that could really throw a wrench in things in 2016. We'll watch it for you. And of course, we watch this stuff every day and keep you on top of it on the cutting edge. Take us up, sign up for MBS Highway. Do you know what? The price of MBS Highway is less than $1 a day. Less than $1 a day. What can you get for $1 a day that will help your customers and help your business? I mean, think about it. If you're not really willing to invest $1 a day in your customer's future, in your future, is there something wrong with that statement? Maybe. Sign up. Talk to you soon. Bye-bye.
Today's Master of the Markets was brought to you by United Wholesale Mortgage.
At UWM, our AEs receive over 500 hours of training each year to keep you current with the industry. We give you direct access to your own team of underwriters who return your calls in 3 hours or less. And we provide exclusive products and tools that give your business a competitive edge. In fact, everything we do at UWM is dedicated to championing your success, which is why more brokers choose UWM than any other lender. World-class service, exclusive products, groundbreaking tools, and you. Get united with us at uwm.com.
This is Mortgage News Network.